welcome back to Simply Money. Tonight we have a special guest with Mike Khouw from YieldMax. Mike and I are going to be talking about things, all YieldMax funds. We're going to be looking at SCHD, BIGY, ULTY. We're going to see what MISTY's done. We're going to recap some of 2025. You're going to want to stay tuned for this episode. We have some great information. Mike is a wealth of knowledge, and he is here for you to be able to answer some of your pressing questions. And you'll want to stay till the end where he talks about the power of the ROC, what the return of capital really means to your taxes and your returns. So stay tuned as we dive in. All right, welcome back, Mike. It's good to have you with us. For those who are new to following our channel, this is Mike Khouw. He's been with us before. He's going to share a little bit about YieldMax. We're going to ask some questions and dive into some of the funds that YieldMax offers. So, Mike, if you would, for those that are new to the channel, just give a quick overview of who you are and why you're here.
Sure. So YieldMax ETFs, I guess I'll start with that, is just a family of high income ETFs. We have some single stock strategies where we use options as an overriding tool to generate premium. We have some diversified strategies like BIGY, which focuses on large cap stocks and does some options overriding on that. And we have some sector-based strategies as well that focus on things like semiconductors, and we actually have some new ones coming out that focus on mining and defense and things like that. Overall, there's about 60 of these funds. Because these funds employ options fairly heavily, my job as the YieldMax strategist is essentially to communicate with investors who might have a little bit less familiarity with options and how they can be deployed and how they're being used specifically in some of these funds. My background is in options trading. I started as an options market maker on the Philadelphia Stock Exchange in the late 1990s. I also worked on the American Stock Exchange and the New York Mercantile Exchange, and I worked for Cantor Fitzgerald, which is a bank and broker based in New York, where I focused on institutional options trading, and I have a little buy-side experience as well. So that's sort of my background and my job.
Great. Well, thank you for that. It's nice to have you with us again. I'm going to dive right in with some questions that were given to us. But before we do that, my first question I want to ask is, it's kind of more of a statement question, is most income investors think options are risky. I get that a lot on my channel. People who are not into covered calls, they're so afraid of them. What do you think the biggest misconception you see right now about these covered call ETFs are?
So I guess one of the misconceptions in these ETFs is that the only thing they're doing is selling covered calls, as opposed to what most of these strategies actually are doing, which is selling covered call spreads. Meaning that, in the single stock funds, the objective is to have some long exposure to the underlying equity and to sell some upside premium against that. And the way that's being affected in most of these funds is actually to sell call spreads, not just outright calls. So the idea is that you get a little bit of a tailwind from collecting options premium, regularly selling these options week after week. But by selling a call spread, so you're short one upside call and then long a higher strike call of the same expiration, if a stock really takes off, you still get to have some participation. So I think the biggest downside that some people see to covered call strategies is that if a stock suddenly has a really big upward move, and we have that from time to time, you don't get much of the capital appreciation because you've essentially sold a significant portion of the upside in the stock over some period of time to the buyer of the option. By doing it in form of a call spread, that's going to be mitigated somewhat. So you still do give away some of the upside, but certainly not all of it. We've actually seen some of that this year. If you take a look at MISTY, which is the covered call ETF that tracks strategy stock, MSTR, formerly known as MicroStrategy. MicroStrategy's gotten off to a pretty good start this year. In fact, I'm actually going to take a quick peek on my Bloomberg terminal and see what the returns are so far this year. So strategy is up about 12.5% so far this year. And if, this is in just a couple of weeks, normally if you had sold covered calls, you might have gotten a small amount of premium, but a lot of that appreciation would be sacrificed. MISTY is up 10.5% so far this year. So, MISTY significantly outperformed strategy last year. Now, it was a bad year for strategy stock, but because it was collecting premium, that was a little bit of an offset. So the objective is to, by selling call spreads rather than just outright calls, to get some additional upside participation. And late last year, we saw that in a couple other stocks that had relatively sharp upward moves in very short periods. AMD was an example. NVIDIA was an example, that kind of thing. So I think that's a misconception. With respect to your viewers who think that options are risky, they can be. Investing in securities can always have some embedded risks. Shorting stocks has risk. It's understanding those risks and managing them, I think, that is what's really important.
And tell me if I'm off on this, and I share this with my channel a lot. So if I am off, I would love for you to correct me to make sure my viewers are getting the correct information. But I always believe that it's better for these covered calls, obviously, to go up, but not skyrocket. Like you said, just a quick burst, you miss some of that upside. But if you have a little volatility, kind of the 2 steps up, 1 back, 2 up, 1 back, is that where you're going to make better with the premiums and still gain some of that upside because you're not just shooting straight up past the mark?
I think that where an overriding strategy is going to underperform is indeed if the underlying asset just goes straight up. But I think an important thing for everybody to remember is that, and we have some short funds too, so I should just caveat that by saying there's a strategy that is long Tesla, and there is a strategy that is short Tesla. There's one that is long strategy. There's one that is short strategy. So, making sure that the underlying thesis, the directional bet, is consistent with your view is important. Look, if you get into one of these things and the underlying asset just goes up in a straight line, you're going to make money. That's a win because you're long the underlying asset. You're selling premium against it. So you will get some portion from capital appreciation. And you may or may not be realizing all of the premium because if it goes straight up, you might actually end up foregoing some of that upside. But if it's sort of moving up steadily, I think that's usually the sweet spot. The idea is that you're capturing the capital appreciation of the stock and you're also capturing the premium from the options. But, the important thing I think for everybody to remember is that the stock going up, that's a positive. Whether you're in a buy right, whether you're long the stock, really the distinction is going to be in the relative performance between them. In other words, if it goes up very slowly and steadily, the buy right strategies, the covered call strategies, the covered call spread strategies will probably outperform the underlying equity. If the stock just rockets higher, then you just obviously be happier just simply owning the stock or owning calls, So really how it goes higher is going to determine whether one strategy outperforms the other. But at its core, if you buy one of these things, you want the underlying stock to go higher.
And like with anything, if we had a crystal ball, we'd know which one would be the best one to get in at that time. And that's what we get a lot with this is, you just mentioned MISTY had a rough year last year because strategy had a rough year. And a lot of these people are comparing to the underlying that have maybe been out for 10 years or 100 years, whatever the case might be. And then these funds might only be a year old. So they're looking at a very short window. And it just happens that window is not so great. But over long term, can you share a fund maybe example where you see that it's new and it's struggled some, but maybe that's just the market turmoil for this particular year versus if we were able to see more of a 5 or 10 year picture, that you'd probably see that level out a little bit different?
I mean, I guess rather than picking one that has struggled, why don't we take an example of one that's really taken it on the chin? And that is, for me, that would be something like MENI, which is a covered call on Moderna. Moderna has been a complete disaster as a stock. This was a This was a name that obviously it was a darling coming out of the pandemic. This was because they were probably, one of the two best known companies for COVID vaccines at the time. Moderna was one, and Pfizer was the other. Both of those stocks rocketed higher on expectations that, number one, they had come up with a highly efficacious vaccine, and number two, that as this virus was going to be evolving over the course of time, they would be selling these vaccines perhaps in perpetuity, right? So they had somehow come up with a money printing machine. Fast forward, and we now know some things that we didn't know then. Among them, there are some questions about whether those were really appropriately used as far as younger people are concerned that were already at low risk. There are some concerns that some people had adverse reactions to these things. And, the net effect of this is that the assumption that was made several years ago that they were just simply going to be giving 6-month boosters to everybody on the planet indefinitely, that has proven to be unfounded. And the net result of that is that both stocks fell very sharply since that time. In fact, I'm actually going to pull it up here. Now, in Pfizer's case, this was, obviously it was bad for the stock. It fell quite significantly, but this was not their only product, right? So, they kind of reverted back to what Pfizer was before all of that happened. But in Moderna's case, this was the material portion of their revenues at its peak. I'm actually going to pick this up right here. So we had a high, let's just put my calculator. So the stock hit a high on August 10th, 2021 of $497.49 a share. And it has subsequently hit a low in November of last year of $22.28. So that works out to a decline in the share price of 95.5%. The stock is down 95.5% from its highs. Well, MENI, which is a covered call strategy on Moderna, let's see how this one is down, of course, too, because remember what these strategies do. They either buy the underlying stock or they buy a proxy for it, which is what we call a combo. So you're long a call, short a put of the same expiration and strike. It's a synthetic way to get long the stock. And this has not been around since 2021. It has not been around since the absolute highs. But if we go back to its entire existence, which dates back to, late 2023, it has obviously fallen quite precipitously. So I'm going to just put this in and say, okay, so if you had just taken the dividends in MENI from October 24th of 2023 and held it all the way to the present day, you would be down 28%. Okay, so that's from 10/24/23. And actually, you know what? I can probably show, this might be a useful time for me to share my screen so we can just take a look at the relative performance of a covered call strategy versus the underlying. So this is, essentially what Moderna has done since 10/24. This is MENI since 10/24/23. So what I'm going to do here is I'm just going to put in a quick comparison chart. So 10/24/23. This is MENI. And we're going to put in Moderna. So this is if you had reinvested, here, let's go back right here. Oops, sorry. I screwed that up. I'm going to put two different screens and I'm just going to toggle back and forth. So we were going back to 10/23, 2023. That is Moderna. So you can see the total returns right here. 49.95%. So that 95% I was talking about dates all the way back to 2021, but MENI hasn't been around that long. And if we put MENI in here, which has been long the stock but collecting options premium, we can see that net of the premiums that you collected is down 28%. So what has happened is you have lost because you were long the underlying stock, because the stock has declined precipitously. We just saw almost 50%. Some of those losses, though, were offset by the fact that you've been collecting these cash dividends along the way. So, I think that's kind of small consolation. And by the way, you can see all of those dividend distributions here. Those are the Ds that you're seeing. So it used to be what was called a 4-week payer, and it became a weekly payer more recently. But I think this is one way to think about it. So you're going to mitigate some of the downside risk. If it really takes off, you can potentially forego some of the upside. And the example that I was just providing when we were talking about this, I might as well show the same screen, except I'm not going to use Moderna this time. We're going to look at something that's actually working. A little bit happier circumstance. So here you have MicroStrategy since December 31st of last year. And you can see that, the stock is up 12.5%. Because in MISTY, you are selling off some of your upside potential. Here, you're up about 10.3%. But, let's put them all together. So the highs for MISTY last year took place on July 16th. So you can see what's happening here. The stock fell and then came back. So if you were in MISTY, 47.8% was the decline. If you were in MicroStrategy, so again, we're looking at, kind of dismal examples, stocks that didn't do so well, you're going to see 62.5% decline. So this outperformed. Again, it's not a big consolation. We took 2 examples of stocks that have done very poorly of late and said, well, what happens if you do overwriting strategies against those stocks? Well, if the stocks go down, that's bad. If you're selling calls against them as they do so, that's less bad, but it's still bad, right? So I think it's important to acknowledge that. On the other hand, if a stock does well, then you're going to end up with, more positive results. So, here we're looking at, I'll go back to the beginning of the year, last year. So, this is NVIDIA, right? So stock is higher, collecting distributions. If you just simply took the distributions in cash, it's going to behave like that. So I think that gives people sort of a flavor for why you want to make sure you're investing first in stocks that you really like. And if you were, looking at a basket of stocks, I mean, semiconductors in general were probably the best place to be last year as a sector. And you end up with results that look a little bit like this. So I think that's kind of the important thing
And
to
just
remember.
what's the total return? That's SOXY. For those that maybe are on a small screen and can't see that, this is SOXY. And what is the total return on that for that 1 year you're looking at?
This is the presentation. So let me just look at last year. I think that's probably better. So the total returns just for last year, so that's from December of 24 to December of 2025, just over 34%, right? So the share price is up 20%, and then this is a target 12. So the objective is to provide about 1% per month. There's a little bit of a compounding effect in there, so it actually worked out to slightly more than that. So that's 34, just over 34% if you had just taken the distributions in cash. Because the stocks were doing well, if you'd reinvested the dividends along the way, you'd have done slightly better, 36.8% for the year. So not a bad.
Either one of those are pretty good.
Not a bad place to be.
So, and I think you hit a really important point that I like reiterating with my viewers is you have to know and believe in the underlying stock or funds with these covered
100%.
calls, because people are, a lot of people are just attracted. They see the yield. They're like, oh, look at the dividend or the distribution. Look how much it's paying. And then they get into it and they see something, let's say MISTY, they got in it and then they see the share price dropping and they don't understand what's happening. And they just feel like, oh, this is a bust. And then they get out real quick and then they locked in those losses, just like if you would with VU. I mean, you get in the S&P 500, you're just like, oh, I'm into it. and you happen to buy at the beginning of 2022, and end of 2022, you're like, oh, this is horrible, I'm out. Everybody knows the S&P 500 did really well in 23, 4, and 5. So
yeah, well, actually, I mean, on my screen right now, I have a couple different, strategies that one could think of. You mentioned VU. I think SPY is probably the best known proxy for the S&P 500. So SOXY, we have that at the top here. We can see that the total returns are, if you'd reinvested the dividends, very good, 36.8%. We already know that. But that's because it's the semiconductor space and that sector outperformed. So a fairer comparison might be to compare BIGY, which is essentially, it's kind of a proxy for the S&P 500. It's the 50 largest publicly traded companies, cap weighted. And if you think about it, the top 50 companies in the S&P 500, for all intents and purposes, are the S&P 500. So, the total returns for BIGY last year, that's December 2024 to December 2025, was 19%. And for SPY was 17.7%. So it performed very much like the S&P did. It actually, net of fees, outperformed slightly. I'm going to highlight these things so we can compare it. So the yellow line, if you're looking at my screen right now, that's SPY. And this orange line is BIGY. So you can see it's a little bit higher. Just going back and forth between them. For good measure, I threw in some competitors' funds as well. We've got Neos in here. They have an S&P 500 high income fund. That one underperformed the S&P very, very slightly by the Bloomberg's numbers here. The Global X NASDAQ 100 covered call ETF, it's the NASDAQ 100, so it's not exactly the same, but it gives us some sense. And then JP Morgan has an equity premium income ETF, and that's down here. Now, I'm not going to dismiss the fact that in the case of the JP Morgan equity premium income ETF, it had, if you can look at this period down here, you're going to notice that I'm just going to circle that. This is the drawdown period. It has the benefit of lower volatility, right? So some option strategies have higher volatility, and that can lead to better gains when things are going well. It can lead to bigger losses when they aren't. JEPI is obviously a very different kind of a product. It has significantly lower returns. It has significantly lower volatility too. So I think the important thing that people really need to focus on with these strategies is, number one, as you say, do you like the underlying assets? I think in the case of something like BIGY, I mean, do you like the top 50 by market cap weight? I think if you like equities, then of course you do. That's, it's kind of a generic proxy for the market overall. So, I think if you like equities, then you should like that one. It's going to exhibit characteristics that are very similar to the broad market itself. The critical distinction between it is that if you bought SPY, you're not taking 1% distributions every month, whereas if you bought BIGY, you are. So for a lot of investors, for income-focused investors, that's an important distinction.
yeah, that's great seeing that chart. I appreciate that. And, the volatility, for my viewers, one of the things to understand is even with these covered calls, you're going to have some that are more volatile than others. And some funds you have to kind of hedge you against those drawdowns. For me, one that I use, some people, will scorn me for it. I like SCHD as a kind of a cornerstone for my portfolio. It doesn't skyrocket like some of these others. I could have bought Google, and I would have made off way better. But it's also helped hedge me in downturns when the market pulls back. It hasn't pulled back as far.
Yeah, actually,
And,
what I'm going to
I have
do?
other strategies for it as well.
I'm going to actually put JEPI and SCHD in here together. So JEPI is the JP Morgan Equity Premium Income ETF. You're going to observe that these two, so this is JEPI and this is SCHD. JEPI, SCHD. You can see their characteristics
And
are...
that's the last year.
This is
correct?
last year. That's right. You can see that their
Yeah,
characteristics are vaguely similar. I think that, SOXY to me is arguably one of the best examples, number one, of these strategies when they're working well, when they're doing their thing, but also, how volatility and risk and reward can differ. I mean, in SOXY's case, it obviously vastly outperformed the broad market. It outperformed BIGY. It outperformed all of these other funds. But it also exhibited bigger volatility. If you look at that drawdown period in April, it fell much further. It fell formally into a bear market in early April in that post-Liberation Day tariff tantrum era, where some of these other ones like SCHD, which you mentioned, did not. JEPI did not. This NEOS fund did not. S&P did not actually. We had an intraday S&P price that was officially bear market. I don't think we actually got there, though. And the same thing with BIGY, right? So, that's the other thing, is that when you look at these strategies, to your point, it's not sufficient to simply say, oh, I love this one because it has the highest yield. Next, you want to take a look and say, okay, am I comfortable with the underlying assets? If you don't like Moderna, I'm not a big fan of Moderna or Pfizer for that matter. MENI would not be for me for that reason. That's not stock picking advice. There are probably a lot of people who know more about Moderna than I do, but it's just not my thing. So I would never end up with MENI as a result of that. But the other thing you want to take a look at is just the volatility. Is this a more volatile instrument? Is it a more volatile stock, or is it a more volatile basket of stocks? Robotics, AI, crypto, semis, those are typically going to be higher beta. We have single stock strategies on Microsoft, Disney, JP Morgan. Those are generally going to be much lower volatility. And of course, something like BIGY is going to have volatility very much like the S&P 500 itself.
And even something, looking at this is a 1-year window, which in the investing world is a very small time frame. You have people who want to try to get it all, and the whole throwing all your eggs in one basket is something I always harp on. Is you have to have some diversification, a lot of different schools of thought on that. But I think about something like Moderna, in 2020, you could be really high on that thinking, oh, look at the forecast of this is going to be great. And then all of a sudden your whole nest egg is gone.
Yeah.
And so I think that's why it's important to obviously understand what you're doing a little bit, but not try to get all the risk and not hedge against some of that.
We are looking here at
Moderna.
Not at Moderna, at in this case BIGY now, which is the top 50, and you're going to see that this is a pretty well diversified basket of stocks.
Right.
Are there some more volatile stocks in here? I suppose Nvidia is more volatile than the market a bit. Broadcom certainly is, but a lot of these other names are not particularly volatile. Costco, for example, that's not a volatile stock. Procter and Gamble is absolutely
Johnson & Johnson.
These are very low volatility, and they're not necessarily highly correlated with each other. And here's a really important point. They don't necessarily have much conditional correlation. What do I mean by that? If we take a look at some portfolios, they might have had a lot of exposure to crypto in the middle of the year and through the back half of the year. They might have also had a lot of exposure to other high beta stocks. And when we saw a really interesting dynamic take place in October when Bitcoin started to roll over. So Bitcoin hit its all-time high in early October of 2025, and then it fell sharply thereafter. And as it did so, a lot of other stocks went with it. Sometimes stocks that you wouldn't have thought necessarily had a functional correlation with them. Hims & Hers, generic pharmaceutical company. What does that have to do with Bitcoin? Well, not much really, except that it was high beta. It was kind of a risk-on type of a name. Palantir. They do business with the government, and they are not a crypto stock per se. And yet, as crypto rolled over, Palantir fell with it. High risk, sort of risk-on, risk-off kind of a thing. Something like a diversified basket like BIGY is just going to behave like the S&P. If you can stomach equity risks could probably stomach something like this.
Yeah. Yeah, I think that's great, seeing those comparisons and how they move differently. But I'm going to say it, Mike. I'm a little hesitant to bring this up because I get a lot of feedback right now on this. With ULTY, it has gone through several changes. Obviously went to the weekly pay back in March, and then you guys kind of redid some of the underlying funds and the way it was operating. Can you kind of walk us through some of the changes that have been made, why they did that, and kind of what they expect to see going forward? Because a lot of people have been spooked. I know the AUM's dropped significantly from kind of its peak, maybe in August,
Yeah, I
September.
mean, the AUM has fallen, from its peak, I suppose for two reasons. One of them is because the assets themselves have, fell. So that's going to reduce your AUM even if nobody redeems any of their assets. And actually, this is probably a poster child for what we were just talking about, because the correlation of the securities that the portfolio managers had in that fund up until it reached its peak, which was right around the same time as Bitcoin, early October, was not particularly high. I actually happen to have, and I may have shown this to you before, so for anybody who happens to be interested, I might as well just throw it up now. So this is a basket of the stocks that were in ULTY going into early October of last year. And, when the colors on this matrix are brown, that means that the pairwise correlations for those stocks to each other was relatively low. And if they are white, then what that's showing you is that those stocks are fairly highly correlated. You'll notice that right down the diagonal here, where you see all of these ones, those are the pairwise correlations with each other. So, for example, here's Palantir on this side of the matrix, and it's also over here. So, of course, the stock is perfectly correlated with itself. So the diagonal is always going to be 1. So this is the correlation, the pairwise correlations, and you'll see that some of them actually weren't correlated at all. So CoreWeave and Hims and Hers, which was that generic pharma company I was talking about, they actually exhibited a slightly negative correlation. And you can see that in a couple different places. Here's another example, Hims versus Lucid. Those companies don't have anything to do with each other, but sometimes correlations can be higher and sometimes lower. But in general, you can see you have a fairly diversified basket in here. The places where you do see correlations, in many cases, are kind of where you would expect to see them. So what do I mean by that? Like Coinbase. So is it that surprising that Coinbase exhibits some correlation to Robinhood? Well, no, right? Because, you have self-directed investors who are going to be, operating in both spots. How about MicroStrategy, that's over here, and Bitmine Immersion, which is both of these are in the crypto space. So is it that surprising that they exhibit some positive correlation? No, it's not really that surprising at all. Well, what happened after Bitcoin started to roll over is that in many instances we saw the pairwise correlations for these stocks go up pretty considerably. So I'll just go out to, let's just say November 15th, or go out to 5 weeks, something like that. There's a lot of white in there, as you can see. So the relationship between a lot of these stocks and their relative performance suddenly went up quite considerably. I mean, you can see that Robinhood, for example, had a pairwise correlation with Palantir of 0.77. Remember, 1 is perfectly correlated. That's how correlated a stock is with itself. Now, these kinds of correlations, Bitmine Immersion to Coinbase, I expect that. But, did I necessarily expect to see that it's Coinbase's correlation to Palantir would become so high? No, not necessarily. That seems a little bit out there. So what has happened in the fund, and we can kind of see that if we look at ULTY's constituents now, is that Michael Venuto and others on the ULTY investment committee team said, we don't want to lose, and Jay Petrocelli, they did not want to lose YieldMax's objective with ULTY, which is, to look for opportunities to sell premium against high volatility stocks. They have higher options premiums. It's in the name, ultra option income, right? So, but one of the things they definitely did try to do was carve out at least a sleeve of the portfolio that was unlikely to exhibit huge amounts of conditional correlation the way that happened then. So naturally, the fund would have had a lot of risk on stocks because those were the volatile ones. But now what are you going to see? One of the things you're going to see in there is we've got gold miners. So gold miners are not necessarily, or copper, so these are not tech or anything like that, right? Eli Lilly, same thing. These are pretty unrelated. Las Vegas Sands. So are we still going to see some of the kinds of names that we did before? Well, remember, Robinhood was a constituent of the fund during the summer, and it still is, right? Palantir, it still is. But you are going to start seeing things that look more like copper, gold, situations where I'm not going to say they could never exhibit any correlation with each other, but it's a separate sleeve, and that was sort of part of the objective. And so there was a slight revision that took place to the investment process that was codified. They put a sticker on the prospectus, which I think was published on December 8th, if my memory serves me correctly. And, there have been some changes. So if we actually take a look at the performance of ULTY, since, call it December 1st, so I'll just stick that in here. Total returns of about 4% over that period of time. And if we take a look at how, we were using SPY as a proxy before. We'll do that too. The S&P's total returns are about 2%. So it's about doubled the performance of the S&P since round about the time that the changes took place. Now, that's a very short window of time to compare. I mean, we were just talking about it. If 1 year isn't much of a track record, then certainly a month and a half or thereabouts isn't much of a track record either. But I think people are noticing that the constituents are probably not going to get white hot the way that correlation matrix did before. And that's I think the most important thing to consider if you're looking at the fund, what changes got made and what didn't. What didn't? Still focusing on trying to get high options premium. It's still going to have higher volatility stocks in it, especially on a weighted basis, than the S&P 500 does. It's part of the strategy. What can you expect out of a fund like that? You can expect more volatility. You can expect higher options premiums. If the market does poorly, its beta is greater than 1, and you're long those stocks, right? So, you can kind of expect that the drawdowns will be greater. We saw that with SCHD last year too. But if the market rallies, it also, that beta can be a friend. So is it a headwind? Is it a tailwind? What the market does is really going to dictate that. And you know what JP Morgan said when he was asked about what the market would do? If someone's going to ask me that question, I'm going to say, what's it going to do tomorrow, next week, next month? I don't know. It will fluctuate. That's what markets do.
Yeah. And I think that's part of where people get caught is they want to know what tomorrow holds. And nobody knows.
We all want that. If I had the answer, I'd be happy to tell you, but unfortunately I don't.
Yeah. And would all be very, very wealthy. So I appreciate you sharing that with ULTY. Do you see any concerns going forward, like maybe additional changes they may need to have with this, or do you guys feel pretty confident where you're at with the changes?
First of all, I participate on the ULTY Investment Committee conference calls, and I think a lot of people probably don't realize that the investment team at Title and YieldMax is a pretty big one. I think there's 52 people overall. So obviously most people know who Jay Petrocelli is. Most people know who Michael Venuto is. Many know who Scott Snyder is. But there is a large a large team in addition to those three. And I think the important thing to recognize is, what is the investment process? And you can, of course, always take a look at what the holdings are. They get updated every night, so it'll give you a sense. But at a high level, the things that they are trying to focus on, they're looking for stocks that have momentum. So in general, there will be what we call special situations. That's going to be circumstances where maybe a stock is just perceived to have gotten too cheap, or there may be some other reason why it's going to be included. But there is a criteria that involves looking at a stock's momentum, looking at some of the fundamentals. For example, looking for positive revenue growth, positive EPS growth, ideally margin expansion. So those are going to be things that the PMs are looking at. There's going to be what I talked about, which is a non-correlated sleeve. Not the same thing as anti-correlated, but just a sleeve of the portfolio that the constituents of which don't generally exhibit positive correlation with the other portions. So that could be what you're seeing with the metals, for example. But I have seen tests that go back using the investment process that they have implemented. And the results of those tests are very good. And it should also be mentioned that folks like Mike Venuto and Jay have lengthy track records in the business. And even some of the names that you guys may not be familiar, people like Dan Weiskopf, these are folks who have been managing money for a long time. And, sometimes people will outperform and sometimes they'll underperform, but they have good operating records as fund managers individually. And the process, when we test it, also has very good results over time.
And this is a good time for me to throw in that this is not financial advice. This is for education and informational purposes only. With that being said, can you give us some education and information to my viewers who might say, Mike, I've bought into ULTY and I am down, whatever percent. I've heard some pretty decent percents in there. What would you tell them to do? And obviously they have to make up their own mind and make their own decisions, but how would you encourage them to handle that 6 months, 8 months that they've been holding ULTY?
Yeah. So, well, let's take a look at that and just sort of see, let's see what it looks like. Well, so let's assume that you were in it for the last 8 months. First of all, make sure that you are in alignment with the fund's overall strategy. We can take a look at the individual trades that are in it in just a moment. But so we're in January now. So if I go back 8 months, I guess that would take us back to May? Is that right? That should be.
That's right.
Yeah. So if you bought it in May, well, you actually wouldn't be down. You'd be up 9%. So I guess we'll have to pick a different day. I'll just go to its all.
Right.
How about?
Okay. I was going to say try July.
All right. So we'll go May. Yeah, we'll go to. So here we are. So if you had bought it in July, you'd be down 6% net of the dividends you received. So obviously not the best possible performance. I mean, like I said, we know exactly what happened when Bitcoin rolled over. There was a lot of risk off trades in this basket, and it underperformed. One thing I would say is because there have been some mild portfolio construction approaches that have been changed a bit in the way I just described, it's not like it's simply going to round trip. It's going to behave a little bit differently. The volatility of the fund overall will probably be lower than it has been. Some of the distributions have come in slightly, but I think overall the distributions have still, sort of adhered to the name on the tin, if you will. So it still has very high distributions. Look, whether or not you want to be invested in this fund really gets down to whether you like the stocks that are in it and you like the strategy in general. The strategy in general has proven itself. I think if you look at something like BIGY and BIGY's performance relative to the S&P, it speaks to the strategy overall. Does it always outperform the S&P? No. But in general, it handles its relative performance very well. It outperformed net of fees. in 2025. Will it always? Not necessarily, but you'll see, and as we did see in that other chart I think I had over here, what we can see is that its risk and return characteristics are very similar. So ULTY is going to be it's going to behave essentially a little bit like this. It's going to be somewhere between something like a BIGY and a SCHD in the general case. Now, SCHD obviously was a hot performing sector, but my point is that ULTY is a more volatile fund. And if the kind of volatility that you experience is more than you're comfortable with, it probably isn't the right product for you. And you can see that, we had a situation here this was the high on October 9th. From here it was up 7.5. So peak to trough, it fell 22, almost 23% right here. So from early October to, mid-late November, that was a bad time for the stocks that were in this thing. Again, these are higher volatility stocks. They had somewhat greater pairwise correlations. If that's not something you're comfortable with, I don't know that SCHD, which is the ETF that you have, which has very low volatility, almost no volatility, is necessarily the answer. But maybe something like BIGY is more appropriate if that kind of volatility is too much for you. So really, this chart actually, which includes funds of ours and funds of others and the S&P itself, I think this really speaks to it, is that every investor has a different risk tolerance, and everybody wants to have the net results of the white line. But not everybody can take the pain of, the biggest drawdown. Take a look at this drawdown. So this went from up 10% to down 23. That's a 30 between here and here. That's a 33% decline in 3 months. Less than, actually. This is late January to early April. So in 2.5 months, 33% decline. Everybody says, oh, I want to have the up 37% year. But, you need to be able to, you need to be able to, what can go up by that amount can also fall by that amount. And it did. Obviously, if you'd bought it here, that would have been very nice indeed. And I think probably what ended up happening, and what does happen, is that people will look back in periods of time and they will see some stellar period of outperformance and think that's what I want. And so they're always out there with that performance chase saying, what did best before? And I'll just buy that. Rather than saying, this is a basket of stocks that I like, and this is a strategy that I like, and I will buy that, and I will recognize that the market will give sometimes, and it will take at others. And if you can accommodate that, be patient, dollar cost average, everybody will do fine. But I think, and I'm a victim of this too, it's very hard to remain unemotional about our investments. When the numbers start going down, we tend to do things that, with the benefit of hindsight, we probably shouldn't have.
I think what I see all the time too, and talking to people on my channel, is we're actually doing the opposite of what Warren Buffett warns us when he says, be fearful when others are greedy, be greedy when others are fearful. We're doing the opposite. We see, using SCHD as an example, when everyone's fearful, he's buying.
Yeah. Well, it's interesting.
We're jumping out. We're seeing it go down. We're like, oh, I got to get out.
Well, imagine this. So let's say you did exactly that. So right here, this was clearly peak fear, right? Everybody's panicking. This thing's down more than 30% at that point from its highs in late January. So let's just say that you bought it on that day because you're Warren Buffett and you're saying, you know what, everybody's getting a little bit too panicky. So I think I'm just going to pick this thing up right here and I'm going to wear that until the end of the year. How would you have done? You'd be up 80%.
Yeah.
So, and by the way, it's not to say that there weren't some significant drawdowns in the meantime since. I mean, it obviously has done very well for the year. We can kind of see that right here. But notice what happened in late October to, that mid-late November period. right? So it fell almost 20%. And, if you recognize that that's how these things behave, that's just what happens, then you're going to say, okay, well, I'm going to allocate a portion of my assets to something like this, maybe not all of them, because I'm not going to put my whole retirement into something that can give back 20% of its value in the course of mere weeks. On the other hand, I want to have some allocation to it. So maybe I say, okay, well, I'll put 10% into it. Now, if you had allocated 10% of your portfolio at that peak fear moment, in a Warren Buffett method, I mean, I've never bottom ticked anything. So I'm not going to claim that anybody is going to be effective at doing that. But just speaking hypothetically about making sure that we have the right psychology for all of this, if you have a discretionary portion of your assets that you are willing to deploy, when you really see the whites of their eyes, you can actually get some significant outperformance, because a mere 10% of one's portfolio allocated to this in mid-April would have yielded an 8% boost to one's assets by the end of the year.
Yeah.
So I don't know. Did you
that's
pivot out of your SCHD or one of your, lower risk, lower volatility positions at that time? Or
I did.
okay, so
Yes. I was actually pivoting in April, and then I had some cash. I didn't pivot back in as early as I would have liked, but I did pivot in, and I've done pretty well with it. And I think that goes to show, because I was getting out of some of the low volatility, seeing the sale, but you never know. It's not like, the store says we got a sale this week. You don't know when the sale ends.
That's right. Or you don't know whether
it came back quick.
Yeah, well, you think that everybody says I'm going to buy stocks when they're 20% off. And then when they're 20% off, everybody's afraid that next week's going to be the going out of business sale. So they don't do it. I think your approach, though, isn't a bad one. One of the interesting things about having a more stable pool of assets is that it does permit you to be somewhat unemotional. Let me give you an example. Let's say that I have a $10,000 invested, and let's say that 70% of that, $7,000, is in relatively stable things. So some of that's going to be S&P 500 proxies or like a BIGY or something like that. And 30% is allocated to, the stuff that is a little bit more speculative in nature, more volatile, and those things for which I have a smaller risk appetite. Well, when the market rolls over, if the 70% declined by 5, right? So my 7,000 went down by $350. So I have 6,650 in that sort of core safe basket. And my 30% declined by 30%. So that's down 900. Well, if I want to get back to that same 70-30 balance, now that these others have declined so much, I have to sell some of my lower risk stuff and buy more of my higher risk stuff to get back to that 730. So it's a natural rebalancing effect. And if I just say to myself at the beginning of the year, that's what I'm going to do, then I can be unemotional when that day comes. When those stocks are off 20%, I have to rebalance, so I buy a little bit. If they're down another 10, 20%, I have to rebalance a little bit more. So I sell off a little bit more of the low volatility stuff, add a little bit more of the high volatility stuff. I think rules like this are really important in investing because it helps us take the emotion of the moment out of it. And I think that's important whether it comes to how you select stocks. And I go through the same screening process every day when it comes to that, which I'm happy to walk through. It's a little lengthy, but I'm happy to go through some of that exercise. But if you have just investments in funds, a reallocation or a rebalancing process like this, which is a lot of what institutions do. Institutions say we want to have a certain percentage in real estate, certain percentage in fixed income. Alts, it's a little bit harder because they tend to be illiquid. Equity is another percentage. And when those things get out of whack because one is hard hit or one is doing particularly well, you naturally will sell off some of that outperforming asset. You'll redeploy to some of the underperforming one. It smooths out the returns, but also it oftentimes works out to be a good time to rebalance because you're buying things when they're on sale.
And with that, you were mentioning Bitcoin hit its high was around October, September before it rolled over, and it had a pretty significant hit. And I've been talking to a lot of people about that. This isn't the first time. If you look back, Bitcoin hits highs and then it just plummets, but then it goes skyrocketing past. And it's that, we talk about 2 steps forward, 1 back. With those, it's like 20 steps forward, 19 back. I mean, it's very volatile. And
it's usually 5 and 4.
Going up.
So it's in Bitcoin's case, it's usually 5 steps forward and then 4 back, meaning that it has had multiple 80% declines since the beginning. So I'm going to just pull this up. So the chart that I'm going to show you guys here is a logarithmic chart. And I have to show a logarithmic chart because Bitcoin has appreciated so much over the long term that if I didn't, it would just look like one big hockey stick. So what this really means is that when we see a magnitude decline over here on the left, it will correspond to magnitudes that are similar in the future. So let's just take a look and see what happened. So if we take a look back here in 2011 and we take a look at this decline that took place right there, that was an 81.5% decline right there. Fast forward, I go over here. That was an 85.9% decline. Over here, that was an 83.93% decline. Over here, is that about the highs or thereabouts? 77.5% decline. All right, so that's basically 80. That's basically 80. That is basically 80. This is almost 80. What have we just endured? Every Chicken Little that's out there, I mean, who thinks the world is coming to an end? 33%. I mean,
yeah, we still got a ways to go.
Volatile asset. Okay, make no mistake.
Yeah,
it is a volatile asset. If it was going to have a decline similar to the one that it experienced in the past, it would not be back down, in the 80,000 neighborhood. We'd have been down at 24,000. We're at 95.6 right now, right? That would be similar to the decline we saw in 2011 and 2014 and 2018 and 2022. So
now you just did the highs to the lows showing the 80% drop. Are you able to show from the lows to the high? Yeah. Can you do the opposite after it kind of bottomed out before it hit its next high? What were those increases?
Sure. Well, let's take a look. We'll go from here to that high. That was an increase of 38,000% from the lows. This was an increase of 12,000%. This was an increase of 2,100%. And this one was an increase of, I didn't quite get 700%.
Oh my gosh, it's doing horrible now. 700%.
Well,
yeah, I think people saw this back here and thought
it is a different kind of an asset.
It's going to keep doing that.
It is a different kind of an asset, meaning that, the volatility of the asset has declined. And if risk and reward do have a positive relationship, then as an asset becomes less risky, we might then, assuming the market is efficient, and I'm not saying it is all the time, it's demonstrably not at times. But in the general case, it would be fair to say that you don't expect to make 30, 40,000% in an asset whose volatility is a mere fraction of what it once was. Its adoption, in these early days, if you went back to 2011 and you said, what is Bitcoin to the average person on the street, they would have no idea what you were talking about. And I did not invest in Bitcoin at that time. I knew some people who were investing, and I can remember having conversations with them like, what are you buying and what do you think is going to happen? Where is this going? And I know people, by the way, who were very bullish on it, and they spent it on all manner of things. Like, they were so happy when they could actually use it to transact. I know a guy who told me in 2017, he told me this, by the way, so it was right in here. He had bought a bunch of pizzas with his Bitcoin because he found a pizza place that would actually take them as payment. So he was really happy about that. And by the time he told me, he said those pizzas cost me $10,000 because that's how much Bitcoin had appreciated at that moment. It has since appreciated, since that time, by 9,350% to its peak. So it went up 93.5. So what that means is that those pizzas actually cost him the better part of $1 million.
Yeah, better be some good pizza.
Well, I know somebody who bought an Audi because they found an Audi dealership that would take Bitcoin. And the liquidity in Bitcoin at the time that he bought it was so poor that they actually knocked Bitcoin's price down by something like 6% when the dealership just took his Bitcoin and just dumped it. That Audi is probably now, with the benefit of hindsight, one of the most expensive cars that ever changed hands. I mean, because he almost certainly could have bought a Duesenberg or something with what it's worth now. But that's just the nature of the beast. You know, there was, in the early stages, people hoped it would be adopted. A lot of people believed it ultimately would be. But, you know, the fact that there would be things being spoken of like a treasury reserve, that, you know, real asset managers and banks would start to say, okay, maybe this is a real thing after all. It was not at all clear, you know, in the early days that was going to be the case.
That's great. Thank you for showing that. I think that will help a lot of people understand, one, how the volatility is slowing down, but two, even as non-volatile as it is compared to before, it's still very volatile. And these 30% pullbacks are typically temporary, and then it shoots back up. So I appreciate that. To respect everyone's time, I don't want to, I could talk to you all night long. I appreciate all the wonderful information and education you're providing our viewers. If you could leave us with this one last thought, what is one thing you wish every income investor understood before buying their next fund?
Well, I think that's a good question, and it's an important one. One of the things I think that's really important is for any fund, but particularly those that pay distributions, is give some thought not just to what's in it and the volatility of it. Give some thought to the idea that after-tax income is what's going to matter to you. Okay. Actually, some of my screens just shut off, so I thought for a second that I had lost you, but luckily I did not. And so on this vein, the thing that I'd like to talk to everybody about is return of capital, because we're at the beginning of a new year, right? And so I want people to understand what that is. When a fund makes a distribution, there are a couple things that they may have done that will lead to how that distribution is characterized. So is it going to be an ordinary distribution or a non-ordinary distribution? Non-ordinary distributions, if you're looking at your 1099 DIV, that's going to be the portion that's characterized as return of capital. And what that means is that if you got a distribution, whether or not the fund made money, that means that the allocation, the distribution that's being made to you, did not come out of realized gains. And a way to think about this is, imagine I had a very simple fund and it really had only 2 securities in it. And let's say that the whole fund was up 15% at the end of the year. And then I make a 15% distribution to the shareholders of the fund. Well, if I sold my losing stock, so I didn't have any realized gains, right? I sold my losing stock and I make a distribution, that's going to be a non-ordinary distribution. It's going to be a return of capital, and it's going to lower your basis in the fund, but it's not going to be immediately taxable. On the other hand, if I was the fund manager and I sold my winning stock and kept the losing one, then I'm going to have realized a gain. And when I make that exact same distribution to you, now it's going to be characterized as an ordinary distribution, and it's going to be taxable as income. Now, maybe that doesn't matter. Maybe you hold it in a tax-free account, or maybe you have an offsetting loss. But I think it's important to recognize that all else equal, that return of capital is a good thing, right? Ideally, you don't have a taxable event in the near term. You don't increase your taxes. So as everybody's preparing for their taxes, for those that have invested in these and for those that will, I think this is an important thing to understand. And it's not just us. Fund managers will try, if and when they can, in a manner that is compliant with RIC rules, because, of course, fund managers have a lot of rules that they have to live with, including concentration rules. But if and when they can, they're trying to operate their funds in a tax-efficient manner. And investors should also try to operate in a tax-efficient manner. It's something that you should know. It's something you need to know. I'm not providing any tax advice, but I'm just giving general investor advice that what matters to you is your after-tax returns. And all else equal, if you're getting distributions, that's better than not. I'd much rather have an investment that pays me regularly than one that promises to pay me at some point in the future and I have to wait years and years to get it. So keep those two things firmly in mind. Choose funds whose assets you agree with. You like the stocks that are in them. And, go forth and prosper. And I wish everybody the best for a healthy, wealthy 2026.
That's great. Thank you, Mike. Thank you for joining us. For everyone watching, we appreciate you being here, and we'll see you next time on Simply Money.